Hey there, welcome to the first video of our channel Stox 101. My name is Nick and I will tell you guys how this channel will help you learn all about the US stocks market ranging from the NYSE stocks to NASDAQ stocks. We will provide you with the amazing and timely news updates, stock chart analysis videos and all the valuable information you need to make the right decisions in your investment by our wonderfully put together videos scripted by highly professional, skilled stock markets geniuses voiced by our team of voiceover artists and put together in an easy explaining video by our team of hardworking editors. So for the first video, we will talk about a brief introduction of the US stock markets, things you need to know about it and more important things. But before we do that, subscribe to our channel Stox 101 to receive regular stock markets content. Let's first talk about why invest in the US. Ford versus Tesla is one example of the old versus the new. The story could have easily been Verizon versus Apple, Walmart versus Amazon, or Disney versus Netflix. This is where you make the money. If you had seen the potential of Amazon, Netflix, or Face Video, you would be sitting pretty. The US has driven global technological change over the last 50 years, and the rest of the world has followed. If this trend is to continue, then Australian investors have to learn how to invest in the US stocks. If I were to give you one word answer to why I invest in the US stocks, the word would be innovation. Plain and simple, the US stock markets are not only the largest in the world, but they offer investment opportunities in some of the best and most innovative companies. Of course, the Australian and other developed stock markets, such as those in Europe and Japan, have relevance. But as you will learn, time and again diversification and risk management are key to growing your wealth over the long term. Although some investors are giving up on the US and turning their focus to China and other emerging markets, I believe the US stock markets will continue to play a major role for investors and offer excellent money-making opportunities for this decade. The pandemic has ironically given rise to an acceleration in technological innovation, and the macroeconomic responses to the 2020 recession are creating a forecast uptick in economic activity not seen since the end of the World War II. The combination of these two factors creates a Goldilocks backdrop for investors, which is an economy that is growing without overheating and posing inflationary threats. As long as you are equipped with the necessary information to break down and assess the opportunities in the US stock markets. This video has been created to help anyone who seeks a greater understanding of how to successfully invest in the US. While you may not completely appreciate the subtleties at this stage, the video will guide you through how the US stock markets have evolved to where they are post-pandemic and what lies ahead. Ford and Tesla are the symbolic microcosm of the world of the US investing that I am going to introduce you to. This video is a guide to help you understand how to invest profitably in the US stock markets. And it also aims to deliver you comprehensive coverage and analysis of the biggest debates and investment themes that are set to continue to dominate investing over the next decade. All the information in this video is wrapped up in some final thoughts for you to take away with your newfound knowledge of US stock markets at the precipice of technological innovation and change. And now let's the US journey begin. US stock markets and the major indices. Accessibility to investing in global stock markets have been made possible through the internet, innovation and competitive pressure. The internet offers increased competition from overseas. Low-cost trading platforms have opened up opportunities for average investors. The disruption evident across so many industries have played a part in allowing people like me and you to invest internationally, anywhere from anywhere, even on a smartphone, sometimes with zero transaction fees. The shift to looking overseas for investment opportunities has also been driven in part by lower than average returns until recently from traditional Aussie favorites like the banks and oil and gas companies since 2015. The demographic of investors is changing too. More millennial and Gen Z investors are seeking to profit from some of the big technology names that frame their lifestyles. So our focus in this video is on how to invest, understand and analyze the stock markets in the world. Those portrayed by so many stories in Hollywood film sets around the Wall Street. The USA is not only home to the world's largest and most successful companies, it also continues to dominate the world stage with the size of stock markets. One US stock, Apple, has a market capitalization of over $2 trillion. The entire Australian share market has a market capitalization around $1.5 trillion. It is not unusual for global behemoths like Apple or Amazon to have a size market capitalization in excess of a country's entire stock exchange. There is a generally accepted rule of thumb that goes like this: the US stock markets are the dog that wags the tail for other developed markets such as Australia. This means most world market tends on average to follow the trend set by the US stock markets. To understand the US stock markets, however, we must see them in context. Developed, which means mature, and developing means emerging markets. The US is classified as developed or mature market. Other developed markets include Australia, Canada, the Europe, UK and Japan. Developed stock markets are those where the underlying economies are mature. They usually have lower levels of economic growth but a well-developed middle class and aging population. Developing, or you can say emerging markets, are newer economies that are embracing more Western cultures. Is a lower income class is moving to the more affluent middle class. The economic growth of the country is typically higher than in the developed markets. Per capita income is normally lower than in developed countries. But expectation is for the emerging middle class to grow their wealth and per capita income to reach or exceed the standards of developed countries. China is of course one of the largest economy and market that is considered emerging. Following in its wake are Korea, Taiwan, Thailand, India, Indonesia, the Philippines and Vietnam. For example, other emerging markets across the globe include Brazil, Argentina, Chile, Mexico, Russia, Turkey, Saudi Arabia, Qatar, the UAE and South Africa. In no particular order, the list of countries currently considered to be emerging markets can be found in the Morgan Stanley Country Index. The index may have 1292 constitution, but China represents 42.24% of the index, followed by Taiwan, South Korea, then India and Brazil. Why emerging markets are relevant before you worry that I have gone off course? I want to highlight that when discussing the US stocks market, we need to keep an eye on what the large emerging markets, especially China, is doing. With so much interdependence and friction over trade and technology between the world's two largest powers, the USA and China investors should remain in tune with potential changing dynamics. As much as we might think it's different in other markets, from a macro perspective, many of the secular themes, which we will discuss further in this video, that investors witness in their domestic stock markets are also playing out in other stocks markets, because many of the large companies driving the change are global anyway. We are part of a global investing world, and that interconnectivity feeds into the way stock prices moves when interest rates and currency level changes. Emerging markets tend to perform more strongly when there is a weaker US dollar. This is because many of these countries and the companies listed on their stock exchanges hold US dollar denominated debt. If the US dollar rises, it costs the country more in its domestic currency to service the interest payments or pay off the debt. Conversely, a weaker US dollar is beneficial to serving the debt costs. Emerging markets also benefits during periods of economic expansion, such as the world has experienced in 2021 after the pandemic recession. What's happening in China? The world's largest emerging market is, of course, extremely important for investors in the US stocks markets. In this video, we view the ascension of China through the prism of how it impacts US stocks, stock exchanges, markets, and indices. I understand why investors' eyes glaze over when I'm discussing difference between a stock exchange, a market, and an index. But it's necessary to make the distinction between the three. Put as simply as possible, the stock exchange is the infrastructure that supports the market where the exchange, which is sale and purchase of stocks, takes place. The market is a term loosely used to describe the stocks, which is share, that are listed and traded on the exchange. An index represent the collective price movements of a designated group of stocks. The stocks that make up the index are included based on different criteria. The most common criterion is a market capitalization weight. Market capitalization being the number of shares on issue multiplied by the share price. US stock exchanges and markets. There are three main places to trade US stocks. The New York Stock Exchange, largest stock exchange in the world, and is valued at $24 trillion. It is located at 11 Wall Street in the New York City and was founded in 1792. There are some 2,400 companies listed on the NYSE, and the stocks are traded through an auction between the buyers and the sellers. The NYSE trades stocks included in all major indices, the Dow Jones, the S&P 500, the Russell Indices. Number 2 place is the NASDAQ. It doesn't have a physical location. It is referred to as a dealer's market, where the stocks are traded digitally through market makers or dealers, as opposed to directly between buyers and sellers. The NASDAQ is the second largest stock market after the NYSE and is valued at around $19 trillion. Number 3, OTC refers to over the counter. Specific companies that specialize in the OTC traded stocks will make a market in those companies that are traded but not listed on a specific exchange. OTC stocks are bought and sold to market makers. The rest of the world, to give this some context, let's look at the rest of the world. In descending order encoded in the US dollars, the Shanghai Stock Exchange is valued at $6.5 trillion. Hong Kong is $6.548 trillion. Japan is $6.35 billion. Shenzhen at $4.9 trillion. And Norway and Portugal at $4.88 trillion, and LSE Group at $3.67 trillion. Australia comes in at 16, valued at around $1.53 trillion. Of course, these numbers will be depending on the stock price movements and the value of the US dollar relative to the currency of the stock exchange. These valuations are as at 21 January 2021 from Statistica. US stock indices. There are some 3,500 stocks listed in the US, and many are included in several indices. The number will vary depending upon what criteria are assumed, such as whether the company is US domiciled or traded on an exchange or OTC. Equally, there is an overlap between different indices. Apple, Microsoft are two examples of stocks that are included in all the three major indices. The three most important, well-known and discussed indices are the Dow Jones Industrial Average, the S&P 500, and the NASDAQ 100. These are also the Russell 1200 and 3000 indices, and the list of sectoral indices is described by Standard & Poor's. The most all-encompasses index of the investable and traded publicly listed companies in the US is known as the Wilshire 5000. Look at the indices separately allows you to ascertain the different companies represented. Due to the size and choice of stocks listed in the US, even new investors opt to understand why underlying companies are represented in an index. Each index trades differently depending on the stocks. Stocks, it includes the weighting of each stock in the index, which sector and industry stocks represents, and whether the index has a greater domestic or international slant. Choosing an index to invest in is a bit like going to the cheese counter at your supermarket and trying to decide which cheese fits all your needs. The cheese counter is the index and the different cheeses are the stocks. Is it good value in the right price point? Is it suitable to eat on crackers or best used in cooking? If I am averse to cholesterol, does it meet my nutritional needs? If I avoid to dairy, is it vegan? The indices are not all the same. Each has different characteristics or personalities, trading platforms, patterns, and influences. So let's talk about the buying the US stocks market. Is too simplistic. It is also important that you understand the constitution of an index when you purchase passively managed ETF products that track the index. We will discuss more about this in the later part of this video. When we examine some of the largest stocks in the US and in which sectors and indices they reside. Now let's have a look at some of the most notable indices in turn to shed some light on their structure and composition. You didn't need to become an index expert, but an in theory understanding should allow you to improve your decision making when investing actively managed funds or ETFs or directly in the US. It will also help you understand why some indices move or perform different to others. The Dow Jones Industrial Average. The Dow Jones Industrial Average, also referred as the Dow, is unusual as it weights the top 30 US stocks by the price rather than the market capitalization. The top 30 shares usually represent some of the largest US blue chips. The inclusion of the word industrial in the index name is a hangover from the name given to the index by its founder, Charles Dow. In 1896, most of the stocks in DJIA are no longer classified as industrial, as these are only 30 shares in the index. The index movements are often related to the change in the share price of one or two stocks. The lower the number of stocks in an index, the greater the influence of each stock price. The DJIA was valued at around $8 trillion at the end of the September 2020 quarter. Here is a composition at the time of recording this video in alphabetical order. 3 million American Express, Amgen, Apple, Boeing, Caterpillar, Chevron, Cisco, Coca-Cola, Disney, Dove, Gold Sachs, Home Depot, Honeywell, IBM, Intel, Johnson & Johnson, JP Morgan Chase, McDonald's, Merck, Microsoft, Nike, Procter and Gamble, Salesforce, Travelers, United Health Group, Verizon, Visa, Walgreens, Boot Alliance, and Walmart. The index was most recently adjusted to reflect Apple's 4-for-1 share split, meaning shareholders received 4 shares for everyone they hold prior to the ex-date of 27 August 2020. The split consequently reduced the price of Apple shares. So the index has to reflect the change in the Apple share price. In another recent adjustment, ExxonMobil was removed from the Dow index and Salesforce was added. Many stock markets commentators cited that as a strong example of how the old world economy stocks, oil and gas, is represented by the ExxonMobil, are being replaced by the new world economy stocks represented here by Salesforce. One of the world's largest software companies, the S&P 500, the Standard and the Poor 500, or S&P 500 as it is usually referred to, was created in 1962 and is an index of 500 major stocks from the leading industries in 11 sectors: energy, materials, industrials, consumer staples, healthcare, financials, information technology, communication, real estate, and utilities. We will discuss the sectors in detail later on in this video. The stocks included are not necessarily the largest from each sector. Instead, each stock is weighted by market capitalization and is selected on a number of criteria. is stated at spglobal.com. To be eligible for S&P 500 index inclusion, a company should be a US company, have a market capitalization of at least $8.2 billion, be highly liquid, have a public float of at least 50% of its share outstanding, and its at most recent quarter's earning and the sum of its trading for consecutive quarters earning must be positive. The S&P 500 represents over 83% of the total US equity market capitalization, and thus is a good index to capture the majority of companies listed in the US. As well as being a good representation of the US economy, the most controversial inclusion which was held on 21 December 2020 is Tesla. The electric vehicle, battery and solar panel manufacturers, is controversial because it is the largest inclusion ever made into the S&P 500 with an over $400 billion market capitalization. It is not only the size of companies that's notable, but also the relatively small free float, the shares that are free to trade daily and not locked away in the handle of major shareholders like Elon Musk. The NASDAQ 100. The NASDAQ 100 is market capitalization weighted index of the largest non-financial companies listed on the NASDAQ stock market. It comprises predominantly technology stocks, though it also includes healthcare and biotechnology stocks, and includes companies from outside the US. The top 10 stocks represent around 50% of the NASDAQ, and which companies they are should come is latest surprise is March 5, 2021. The top 10 by market capitalization were in order: Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, Facebook, Nvidia, PayPal, Netflix, and Comcast. Did you see I highlighted non-financial companies earlier? Although many people see NASDAQ is the technology index, due to the large weighting of tech stocks, it is better to think it as simply being devoid of the old economy or value stocks such as the banks and insurance companies. Technology stocks represent 57% of the total weight of the NASDAQ 100 versus 20% of the S&P 500. Is at the end of March 2020 and after the COVID-19 stock markets crash. Looking at the long-term performance of the two indices, the NASDAQ 100 produced a total return of 608% between 31 December 207 and 31 December 220, while the total return of S&P 500 over the same period was 236%. This represents an annualized return for the NASDAQ 100 of 16.2% versus 9.8% for the S&P 500. The Russell Indices. Russell 1000, 2000 and 3000. The Russell Indices were created by Frank Russell in 1984 and are managed by the FTSE Russell, a subsidiary of the London Stock Exchange. Russell 3000 aims to represent the entire stocks market with 3000 constitutional weighted by market capitalization. Russell 2000 is a subset of 3000 and represents the smallest 2000 companies listed. This index is weighted by market capitalization and free float adjusted, meaning only the shares available to investors are included, not the shares tightly held by the majority shareholders. For example, for the smallest 2000 companies listed, US companies, and represents 10% of the value of the Russell 3000. Russell 1000 represents the largest 1000 listed on the US exchanges. The Russell 2000 is often perceived as the best measure or indicator of how the US economy and small businesses in particular are doing, as the larger indices are more often distorted by major companies such as Amazon, Apple, and Microsoft. The constituents of the Russell indices are traded on NYSE and the NASDAQ and the OTC. The Wilshire 5000 Total Market Index. The Wilshire 5000 was created in 1974 to represent the 5,000 publicly listed companies in the USA. The index grew to over 7,500 in mid-1998 in the evolving dot-com and boom, and has since shrunk to around 3,500. The tide may be turning in late 2020 and 2021 with the stream of new company listings, often called IPOs, and special purpose acquisition companies. The index is weighted by market capitalization and only include companies that are headquartered in the USA, are publicly traded on the US stock exchange and which have stock pricing are readily available. The volatility index. The volatility index VIX was created by the Chicago Board Options Exchange, which is also known as CBOE, and is often referred as the fear gauge or fear index for stocks. The VIX represents a live index of the expectations of movements in the S&P 500 in the near term and is calculated from the short dated future options on the S&P 500. In lay speak, it's a price indicator of where the option market expects the S&P to trade in the near term. Investors focus on the VIX as it provides a potential indication of where the US share markets will go. The two generally move in the opposite direction. As the VIX index rises, stocks prices fall. When the VIX falls, stock prices rises. As a general rule, the NASDAQ 100 is the most volatile of the three main indices. That is, its stocks prices moves up and down more sharply due to the heavy technology weighting. The Dow Jones is typically the least volatile and the S&P 500 is somewhere in between. Did you know you can buy an ETF that tracks volatility? The ticker code is VIXY in the US. Although some advisors may recommend you buy this ETF as the protection for the possible future stocks market sell-offs, from personal experience, I would tread carefully. Many of these hedging tools that retail investors can buy have more going on behind the scenes than we are aware of. The VIX and VIXI did spike during the March 2020 sell-off, but once momentum turned, the upward momentum reversed swiftly. From personal experience, playing the VIXY and the bear funds, those ETFs that are appreciated when stock markets falls, can often compound losses. I discuss these types of ETFs in more detail in the latter part. However, I do not see these products as easy risk management tools for the average investor. Also, this video would not go into how quantitative trading and algorithms are executed in the market. So you should be aware that hedge funds, for example, have been using the VIX to generate returns. This has been popular and works well until volatility spikes within exogenous events such as the pandemic. These kinds of strategies work in the good times when stock markets are neutral to positive. Problems arise when stocks falls. Now we will look at some of the narratives that are driving the stocks markets. Other financial instruments for trading stocks. For completeness, I will quickly run through other financial instruments. American Depository Receipts, an ADR or American Depository Receipt, is issued by the US banks so that the US investors can buy overseas companies, including of Australia's largest companies or well-known foreign companies such as Nokia, Unilever, or Royal Dutch Petroleum. The ADR can be traded on the NYSE or over the counter and is a financial security that represents the underlying stocks by a different factors such as 5 or 10 shares per ADR priced in the US dollars. Dividends are paid in the US dollars to the investors. OTC trades are that may require an investor to speak to a dealer, as the orders cannot always be input into a trading platform. Generally, OTC orders is for larger, more sophisticated investors and would allow the purchase of foreign shares on the NYSE or NASDAQ. SPACs or blank check companies, special purpose acquisition companies, which is also known as SPACs, also referred to be as blank check companies. For those who are watching who are old enough to know what a check is, are listed as an IPO, initial public offering, with no underlying businesses. Instead, the cash is used to buy more embryonic companies from the likes of private equity funds, and these are held until the company is publicly listed. Although SPACs have been around for decades, the huge boost in liquidity from the Federal Reserve and the appetite from retail investors for accessing potential long-term winners pre-IPO have made SPACs very, very popular. The mighty bond market. Although this is a video about US stocks and how to invest in the different companies and indices, it is prudent to acknowledge the elephant in the room when it comes to what moves stocks prices. Political advisor James Carville famously said, "I used to think that if there were reincarnation, I wanted to come back as the president or a pope or as a 400 baseball hitter. But now I would like to come back at the bond market. You can intimidate everybody." The quote is famous not only for the baseball analogy, but for its allusion to the size and the power of bond market to influence markets, stocks, currencies, and metals such as gold. The bond market and the shape of yield curve are very, very important. However, as you will see in the next part, the bond market now arguably moves more in step with what Federal Reserve determines, which in terms can be guided by other markets such as stocks. The bond market is government or sovereign debt that is issued by the U.S. Department of Treasury. In the U.S., it consists of U.S. Treasuries, which is also known as bond issued. Australian bonds are issued by the Australian government through Australian Office of Financial Management. The U.S. government issues different bonds with the different durations, which signify when they are due to repay the original amount to the investors who own the bonds, such as 1, 2, 5, 10 or even 30 years. The different interest rates known as the yield are attached to bonds of different durations. Investors buy the bonds when they are auctioned off to raise money for the government, and the bonds then trade over their duration. The more the bonds are in demand, the more the price of the bond rises, and the more the yield or the bond decreases. This is similar to the yield on shares. The more investors push up the price of the shares, the more dividend yield declines. Assuming the dividend payment stays the same, which a treasury bond coupon does, the inverse happens when investor sells bonds. The yield on the bond goes up. Intuitively, the lower the yield on the bond, the less the cost for governments to raise money and the lower the cost to borrow for companies. The International Capital Market Association (ICMA) estimates that the US domestic bond market, defined as the US Treasuries and government agencies at national, regional and local levels, as $22.7 trillion, 91% of which are US Treasuries, those issued by the Federal Reserve Bank. Then there is the US corporate bond market, valued at around $10 trillion with debt maturities as far as 30 years out. There is also a category of financial instruments called Treasury Inflation Protected Securities that are inflation adjusted bond like securities. These are not guaranteed by the government and are therefore not as secure or safe from a default perspective. However, institutional investors buy tips to protect their income returns from a potential rise in the inflation rate, that is the Consumer Price Index or CPI. I explore the relationship between the bond and the markets and the US economy and how this relates to you as an investor. In a lot more depth in the other part, yield curves, I want to touch briefly on the concept of yield curves, as historically the direction of the yield curves has been a signal to the stock market about the future economic conditions. I emphasize that word because there is an increasing amount of expert literature questioning whether the world will ever see a return to historical precedents in financial markets. For the moment, all you need to understand is the following. Number one, a positive yield curve is traditionally when the bond yield, that is the interest rate received by investors, is lower at what it's called the short ends, bond with shorter durations such as 2 years, and then at the long end bonds with the longer duration such as 10 years. This infers that interest rates will rise in the future because economic activity and inflation are expected to rise. Number two, the opposite of a positive yield curve is an inverted yield curve. This is when the yield is lower at the long end than at the short end. This is typically perceived as the harbinger of the central bank having to lower interest rates in the future, and an expectations that economic activity will decline and a recession may be on the horizon. Stock markets are very sensitive to what bond markets do, and this you will often see stocks reacting to the movement in the US 10-year treasury. I explained this in a lot more detail throughout the video when I covered that what has been happening on the US stocks market. So let's summarize what we have said till yet. A stock exchange is a platform to facilitate the trading of stocks. Number 2, an index is a collection of stocks ranked according to different criteria. It can be replicated by an ETF product. Number 3, in the US markets, some stocks overlapped indices in 1962. Later did the expert realize that the solution to the high inflation rates would change the USA's and the world's economic trajectory. The 1980s ushered in a new era. In 1979, the new chair of the Federal Reserve, Paul Volcker, enters our story. Without fear, he hiked up interest rates to eye-watering levels. US interest rates reached a peak of 20% in June 1981, but failing to 3% in 1983. If you happen to have watched the Netflix series The Crown, series foreshadows how controversial such a move was. When the newly elected Prime Minister adopted the same inflation-beating policy, Australia followed suit. However, Volcker's policy worked to eradicate the inflation problems, and similar policies that were adopted in Australia and the UK worked too. No matter how politically unpalatable it was at the time, the accepted wisdom is that overly high or low inflation is not good for our economic prosperity. Central banks, including the Federal Reserve, generally speaking, target an inflation rate of around 2 to 3%. To offer you some perspective, figure 1 depicts the historic US inflation. The higher the lines above the horizontal x-axis, the higher the inflation level. The lines between the horizontal line depict deflation. As you can see, inflation peaked in the 1970s before starting a downward march to current. Historic US inflation rates between 1950 and 2020. Inflation, before we progress further, we need to pause and reflect on the term inflation. It is one of the most used terms in finance, and like most jargon, it needs some explanation. It is also cited as the main driver of whether interest rates goes up or down, and has essentially been one of the most important financial indicators for central banks policy. So it's worth understanding. In my research, I came upon some excellent analysis from Lynn Eldon, who runs a very informative online newsletter service. She defines 3 types of inflation, each with a different driver and influence on the US economy and investing. Number 1, monetary inflation. Put simply, monetary inflation refers to the increase in the money supply, which economists call M2. It includes all cash notes in circulation and bank deposits. When M2 money supplies increase, it means there is just more money in the system. Supply is created by banks and financial institutions lending more, or is happened in 2020. The Federal Reserve injection more liquidity into the system, often called QE or a quantitative easing. It is best not to become too bogged down with different money supply categories, as your target is not to be an economist but a better investor. Number 2, asset price inflation. This naturally refers to the increase in asset prices. Think stocks, property, gold, collectibles, and even Bitcoin. Number 3, consumer price inflation. This is the inflation rate mostly commonly referred to in investing world. It is measured by the consumer price index, which is CPI, the basket of goods and services that all central banks track to establish whether consumer prices are rising or falling. It has historically been, if you recall, the key driver of monetary policy. Through the setting of interest rates, the differences between these 2 types of inflation are illustrated throughout this video. Did the 1980s change our world forever? Going back to Mr. Volcker, I want you to keep in mind that his main aim was to quash the high levels of consumer price inflation. However, he is only one part of the unwinding story. As we have seen that inflation has been trending down from its peak in 1980s. Correspondingly, interest rates have also been trending down. There is no coincidence, but the two are not necessarily directly correlated. Let's take a look at what I mean that. Going back to a big picture economics, the federal fund rates or the cash rate has continued to decline. US 10-year treasury bonds are a good indicator of the interest rates trends and have followed the downward trend. As we have seen before this, that the US 10-year treasury bonds, if we had bought 10-year treasury bonds at the time of issue when the Federal Reserve sold the bonds, we would receive an interest rate payments equivalent to the percentage number shown on the vertical axis of the chart that aligned with our position on the yield line. What is most interesting though are vertically gray lines that reflects US recessions, defined as the 2 quarters of negative gross domestic product. You do not need an economics degree to see that every time a recession starts, the cost of borrowing drops thanks to the Federal Reserve lowering interest rates. This goes back to our history lessons at the start of this video. The Fed has consistently used monetary policy to stimulate economic growth, most notably in the last 4 decades with each recession since 1981. Federal Reserve chairs since Volcker, the famously cryptic Alan Greenspan, known for his obtuse and hard to decipher messages, Ben Bernanke, Janet Yellen, and most recently Jerome Powell, has used over more extreme measures to kickstart the US economy and save it from recession or collapse. The QE money printing in 2009 and each successive chair of the Federal Reserve has at some point during their tenure employed QE to maintain the stability of the US financial system. The premise is that if the central banks lower the cost of borrowing, consumers are all too willing to take advantage of the cheaper money. If we can't become rich through our day jobs, then the central banks can magically allow us to become asset rich by borrowing up big and fulfilling our dreams of home ownership and building stock portfolios. Corporations have also been willing to increase their levels of borrowing in response to lower interest rates. Their borrowing has not always been to increase investments in new business activities to grow future earnings through since 2008. Corporate borrowing has mostly been used to pay out the dividends to shareholders and fund share buybacks. On balance, it is hardly a surprise what is the cost of debt has fallen. There has been a corresponding increase in borrowing and higher levels of debt. However, the rise in the levels of global debt has had a two-pronged impact on the US economy and the world. First, there has been a negative impact on the ability to grow the US economy as measured by GDP. As interest rates have fallen, levels of debt have risen correspondingly to ever higher amounts. Total US public and private debts has increased almost fourfold from the 167.2% of the US GDP in 1980 to an estimated 405% by the end of 2020, according to the Hoingstone Investment Management Company. As the level of debt has increased, the impact on GDP has decreased. In September 2020 quarterly review and outlook, Hoingstone states each additional dollar of the debt in 1980 generated a rise in GDP of 60 cents, up from 54 cents in 1940. Since then, this ratio has dropped sharply from 42 cents in 1989 to 27 in 2019. The second aspect is what is referred to as the financialization of the world, and how we have moved beyond the interest rates being the be all and end all to an issue of balance sheets. The financialization of the world, put simply, financialization of our world refers to how intertwined our economies and personal wealth have become with financial assets. And the figure we have seen that overleaf depicts the growth in global financial assets since 1980s. It clearly demonstrates how of the deregulation of banking industry, ever decreasing interest rates, and the cheaper cost of borrowing, the world has embraced financial assets such as bonds, stocks, or equities and gold. According to Statista, in 2019, the finance, insurance, real estate, rental, leasing sector contributed 21% to the US GDP, which was by far the largest sector contribution. Growth in global financial assets from 1980 to 2020. In his book, The Great Rupture, Victor Schwitz reports that the global debt burden was 322% of the global GDP at the end of 2019, having risen to 37 trillion or 1.5x of global GDP. And finance has also has highlighted the impact of the massive QE program and lower interest rate setting. Global debt has surged another $24 trillion, reaching to $281 trillion by the end of 2020, or 355% of the global GDP. More worryingly, there are financial instruments valued at anywhere between $400 trillion to $800 trillion, which Schwitz describes as the real level of financialization, probably at least 4 times to the global economy, and could even be as high as 10 times. A simple example to explain what Mr. Schwitz is alluding to is when you take out a mortgage, that loan is then packaged up and repackaged as many as 5 times to different investors as financial institution monetize the loan book of lenders. This is not illegal, but it does reflects of the depth of gearing in the world financial system. Michael Lewis's best-selling book, The Big Short, about what creates the GFC, as an excellent reference for further reading. If you would like to learn more about how the concept of financialization has permeated our global financial system, the combination of monetary policy and our voracious appetite for the debt has turned traditional economic theory on its head. The Federal Reserve once used monetary interest rates to increase economic demand through borrowing and investment, meaning the dog wagged the tail. Now the tail wags the dog. Through financialization, the system has become so large and indebted that central banks like the U.S. Federal Reserve must come to the rescue in financial crashes and liquidity contractions, such as in March 2020 with ever greater injections of money. This is what Michael Howell, the managing director of Cross-Border Capital, refers to as the balance sheet problem. The global financial system is no longer about how cheap debt is, but about being able to refinance the existing debt. All this debt doesn't just disappear. It must be repaid or refinanced. So what does this mean to you as an investor? Well, the steady downward march in interest rates that caused debt levels to balloon has in turn caused the US stocks markets, notably the S&P 500, to experience what has essentially been a 40-year upward trend. Figure 4 depicts how the S&P 500 struggled and fell in the 1970s, but it has been in the long-term uptrend since the inflation bursting early in 1980s. S&P 500, if I were to overlay, we would see that the drop in interest rates at each gray line would mark the start of the upward movement in stock prices. The tremendous long-term returns from the US stocks are the result of the greater levels of lower cost depth and bigger balance sheet to support the depth in the US. The other world economies are now so dependent on the US stock market's continued ability to generate wealth that the Federal Reserve and other central banks are beholden to supporting the system. The March 2020 stock market's crash is a case in point. The health response to the pandemic lockdowns constituted a self-imposed economic slowdown. The specter of recession or depression then led to the selling of stocks. However, depth in system meant that once the selling started, some traders and hedge funds couldn't sell the financial securities that wanted to, and instead had to sell other countries to generate cash. The selling created more selling until the system becomes dysfunctional. There was so much selling and not enough buyers that the financial system stopped working. It was at the point that the Federal Reserve and other central banks needed to act. Not unlike in the 2008 GFC, there was systematic risk in the financial system. This event catalyzed the next round of QE to give you some idea just how much money has entered the system. But also the increased competition will have an ongoing impact on margins for the incumbents, and like the technology giants, regulatory changes from the left wing of the Democratic Party may impact on the sector. As a rule of thumb, some of the more expensive healthcare stocks have their stock prices challenged if there are signs of rising interest rates, while others may continue to benefit from pandemic. The cheaper value stocks will likely attract bottom fishing value buyers. Banks, JP Morgan, Chase and Banks of America are banking giants, although they are well capitalized and resilient. Stock prices of all banks around the globe fell sharply in 2020 when the economic recessions hit. Banks are impacted threefold by: number one, a slowdown in economic activity and therefore lending; number two, an increase in provisions for bad debts; number three, a squeeze on their margins as long as end of the interest rates curve fell sharply as the Fed dropped interest rates and used QE to control interest rates further. It is testament to the size and quality of JP Morgan that the bank remained in the top 20 giants in spite of 2020 being such a tough year. This is an expectation improved economic activity as the 10-year treasury rises on the back of vaccine rollout. And to some degree, the Democrat election win brings anticipation of big spending government. Higher government spending will most likely increase interest costs for the country. Hence, the rise in the 10-year treasury. Banks, including these two giants, are very much a part of reflation theme with the reopening of economy as the vaccines roll out. Longer term disruptions and potentially lower for longer interest rates will challenge the bank's business models. Like many in industry suffering the effects of digitalization and disruptions, the banks will have to move with the change and adapt. Telecommunication challenges, AT&T and Verizon remains the telco giants, and both offer a good dividend yield. However, even with the expected growth in 5G rollouts and resulting increased earning, both these companies remain cheaply valued and their business models are challenged. Telco companies around the developed world have all suffered from significant cost pressures. Rolling out and maintaining networks and bidding for new spectrums like 5G do not come cheap. They also face competition from smaller operators as well as from mobile telephony and streaming services. For example, both AT&T and Verizon needed to invest around 15 to 20 billion dollars per year and another 8 to 10 billion dollars in maintaining the networks. Often the full cost benefits is not passed down to the hardware suppliers like the Verizon and AT&T from consumers like you and me. The consistent decline in telephony service price has been the cause of ongoing struggle for these giants. The internet is much cheaper, the cost of phone call is much cheaper, and how many of you still have a landline? The disruption of telecommunications sector will remain a constant, and earnings for both these giants have been low since the GFC. Verizon on balance has fared better, delivering a high share price performance and some earnings growth. Smaller giants that didn't make the cut. Before we recap on this part, it is worth highlighting that the size of the depth of the US stock markets, and in this case the S&P 500, are such that global household names such as Coca-Cola, Nike, Netflix, Pfizer, Merck, Salesforce and McDonald's don't make the top 20. Like the giants discussed, some of these smaller giants will be dealing with the challenges of disruption and change. McDonald's is adapting to online food delivery services, meatless hamburgers, and improved health quality of its fast food offering. Netflix continues to grow and challenge the entertainment industry. Although debates filled around the company, with experts questioning its valuation and the scope of to grow its subscribers base, I would challenge any of you who have enjoyed the trend of streaming entertainment via Amazon, Apple, Disney, or even Down Under to believe that this service is going anywhere soon. Salesforce, one of the fastest growing SaaS software company, made a debut in 2020 on the Dow Jones Index. Although not as richly valued as some other SaaS companies, the general expectations is that growth companies like Salesforce may not perform as well in 2021 if the reflation trade, which higher economic activity and interest rates continues, but longer term prospects remains good. To understand the companies that have the potential to make millions over the next decade, we have to explore secular mega trends. The topic of secular mega trends is so broad that I have split it into two parts. This part offers you an overview of secular investment and how to value growth stocks in the secular mega trend market. Then in the next part, we will explore some specific growth sectors and look at individual stocks. If you are not familiar with the term secular mega trends, then put simply, secular growth is a fundamental change in a sector that creates strong long-term demand for a new products or service that well expects the traditional cyclical upturns in economic activity. Let's leave it to Macquarie's Bank global equity strategist and big thinker Victor Schwetz to define megatrends. Robotics, cloud computing, AI, and 3D printing are revolutionizing energy, manufacturing, and consumption. Beyond atoms lies the singularity, which is the inability to differentiate between human and non-human contribution. This quote is from his book, The Great Rupture. Victor Schwetz belongs to a group of experts who assert that we are on the cusp of the greatest yet technological innovation and disruption with the rollout of the 21st century's secular megatrends over the next 2 decades and beyond. I want you all to envisage autonomous robotics, smart appliances, smart clean energy systems, and digital Bitcoin wallets. All these innovations include or are a part of acceleration of DANCE, an acronym which stands for the growth business sectors of data, algorithms, network, cloud computing, and improved digital hardware. The lines between traditional hardware and software businesses are becoming increasingly blurred as smart hardware embraces cloud operating software as services. As technology analyst Laura Martin stated, AAPL, which is Apple, should be valued as an ecosystem company owing to its seamless integration of hardware, software, and content. We believe, yes, I can hear the guffaws of doubters and naysayers, but I wager that you will make more money by investing in the winning companies or the best in-breed sector class of change. In the third decade of 21st century, mega trends than buying mature businesses is cyclical sectors. The winning stocks, few and far between. We all have intuition and hunches when it comes to investing. But did you know that most stocks will not give you the returns that you are aiming for? Professor Hendrick study, Do Stocks Outperform Treasury Bills, is seminal for many reasons. Arguably, the most valuable takeaway is just how few stocks in the US stocks markets have produced positive results for investors over time when compared to the relatively risk-free option of buying the US bonds, which is also known as treasuries. The study showed how short the life cycle is for most listed companies, that's 7 years on average, and that out of the universe of 26,000 stocks analyzed between 1926 and 2015, less than 4% of the top 1,000 stocks resulted in the $32 trillion of wealth creation above bonds over that period. Investing in stocks is not only about wealth creation, it is a means to grow our savings and protect against the erosion in the value of savings through inflation. Therefore, we are seeking a return that is higher than what the experts call the risk-free rate, usually cited as the US 10-year Treasury bond. The fact that so few stocks are real winners is a stark reminder that not all stocks are created equal, and picking the winners is as important as avoiding the losers. In the later part, you will learn about the US giants and how the stock market views valuation and investing in cyclical versus growth companies. The analysis revealed how many of the so-called value cyclical stocks and old economy stocks have been out of favor, and the reasons for this were explained. Not all cyclical stocks are created equal. Commodity, metal and minerals and energy stocks can benefit from super cycles of demand. Think iron ore prices in 2008 and 2020. The stock price appreciation for such stocks can equal, if not exceed, that of growth stocks. But a rising demand and higher end price products inevitably lead to more supply, depending upon the speed and cost of the new production and sources of supplies. The price for metal, minerals and energy sources can fall. In general, stocks that generate earnings from the input price of whatever they produce are subject to the vagaries of demand and supply. Other cyclical value stocks such as property, banking and credit providers can experience a stock price pop for a while and may seemingly offer value. However, disruption and disintermediation, which is the streamlining of services to reduce costs and the middlemen, for example, direct lending and banking between customers without a bank branch, can threaten future earnings prospects. So that was it for this video and the introduction of our channel. Be sure to subscribe to receive regular Stocks 101 videos where you will learn a lot about your favorite stocks. Thanks for watching this video all the way through, and we will see you guys in the next one. Love you all.